The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, so it is Friday, the 12th of July. Jeremy, welcome back. Good to speak to you.
Morning, Gareth.
So it's been an interesting week, quite a bit going on. So I'm interested to hear what's been the highlight of your week in terms of macro and broader news.
Yeah, I'd say it's been a week of quite good news, really, as far as the UK equity market is concerned. The Labour government honeymoon period is underway, and a more favourable environment for investing in the UK is clearly evident. Mm-hmm. And I think this sort of positive setup for UK equities that we've talked about for a while remains intact. And if anything, I think it's gathering a bit of momentum.
Okay.
Our currency remains one of, if not the strongest and most stable currency in the G7, the developed world, in a world where there is increasing evidence of FX and bond market volatility. And I think you'd be aware of that if you lived in Tokyo or in Paris right now. We've known for a while that the UK economy has been outperforming lowly set expectations. And this week we got confirmation of that if for the month of May, our GDP growth was at 0.4%, not at the expected 0.2%. Now, month on month, these figures can be volatile, but it could mean that the UK economy not just outperforms low expectations, but actually pops out at the top of European growth leagues. So that's obviously a positive. We've got a new incoming Labour government, and it's making all the right noises about getting on and getting things done, particularly in regard to planning and house building. They're doing stuff that their predecessor couldn't or wouldn't do. Couldn't do because they didn't have the political ability to do it, to deliver on it, or ideologically wouldn't do it. So we're getting on with stuff, while, as we've mentioned before, other parts of the world are going through a little bit more of political indecision. Obviously, this honeymoon period won't last, but it's important that they make the most of it while they can.
Seems like they're jumping in quickly, and there's hopefully a lot that can be achieved in a relatively short space of time. And I think people's mindset seems to be certainly positive and, hopeful that they can achieve quite a bit.
Yeah, regardless of what one might think of some of the policies they're adopting, it does sound as though they're rolling their sleeves up and getting on with it. And I think one got to sort of step back from these things and view it from the perspective of a global investor. If you put that in the context of what else is going on in the world, then I think the UK continues to look relatively attractive, particularly if you bear in mind that yesterday we had lower than expected US inflation data, which has meant that we've seen a weakening of the dollar, and juiced up by that weaker dollar, it's moved sort of global capital more into a risk-on mode. Now, what we could be witnessing here, I think, is the early stages of what I'd call the equity dispersal trade. We've known about the concentration of global equity markets for a while, the rise of the Mag 7, and in particular, NVIDIA as one of the largest companies in the world. Well, overnight, NVIDIA was down 6%. NASDAQ was pretty weak. The Russell 2000 was up 2%. And that's a big move in one trading session. And it could be a one-off. But if it's the beginning of a trend, one could argue there's a lot further to go here. And I think in a global context, with the UK equity market representing something like 4% of global equities, we're essentially a constituent of the Russell 2000. So I think this is an extra financial market trend that could really benefit the UK.
Sorry, just to make sure I've understood that correctly. So what you're saying is that US inflation looks like it might be under control or coming down, and that means people are expecting lower interest rates in the States over time and are therefore prepared to take a bit more risk, which means selling some of the Magnificent Seven very highly rated, mainly tech stocks, and pushing that capital out to more risk assets, which would potentially include the UK.
Yeah, a weaker dollar eases financial conditions so the rest of the world can breathe more easily in a financial sense. That easing of financial conditions moves the world to more of a risk-on mode. The safety first equity environment has been one of the drivers of the rise of big tech and the Magnificent Seven. What we have seen, not just in the US, but in Asia overnight, some of the larger tech names falling as the more economically sensitive, smaller capitalized stocks begin to perform quite strongly. I think it's indicative of the way the world could go when we do see lower US rates. On evidence of the inflation data, that's going to come sooner rather than later. Now, you've also got to factor in the political situation in the US, but for now, just looking at the economics and the capital flows on the back of that, I think it could develop into a very interesting trend.
Yeah.
So, what about you? What have you been looking at this week?
So my week's been a little bit closer to home and much more micro cap on the UK corporate scene. In terms of progressive clients, we had news from two of them, DP Poland and Springfield Properties. DP Poland is the operator of the Domino's Pizza franchise in Poland and Croatia. And yesterday we had a very positive update from them. They had like-for-like sales for their H1, which is the end of June. They saw growth accelerating to 22% for the half, but more importantly, Q2 was better than Q1. So they're seeing some really positive trends there. And that's been driven partly by inflation, where they're able to sell their pizzas for steadily higher prices. And they're seeing quite a bit of cost price inflation as well going into that. So there is inflation within it. But more importantly, they've seen a significant step up in what they call the average weekly order count, which is the number of pizza orders they're actually shipping from each store, which grew from 800 in Q4 of last year to about 850 by Q2 of this year. So some significant growth in the actual volumes, the number of pizzas they're selling, and then very close to their target of 900 per week. So that bodes very well for the ongoing growth of the business. We also had a good update from Springfield Properties, the Scottish house builder. They talked about their year to May. Profits overall are in line with expectations. Within that, the group has made up for some relatively sluggish sales of new houses by increased profits on selling some of their land banks. So they've managed to use their portfolio to good effect, and the profits on those land disposals have offset the pressure that they've seen in terms of selling their houses. And I think they've still got a pretty big land bank, and they should be well placed to benefit from some of the new Labour government's policies on house building, should play very well to both Springfield and various other house builders. I think you've seen some news or commentary from Barratt's and Gleeson and some of the others a bit more broadly. Is that right?
Yeah, I think all of them are juggling what their land requirements are. And Alistair's been saying for a while that there's been an increase in land buying activity or land trading activity among the larger owners of permissioned land. So Barratt's indicated that while their sales rate is showing some signs of recovery, they're not going to have enough sites to be selling from in the current year to meet previous expectations. So while they and Springfield and Gleeson see this increased interest in land trading activity and obviously a big political ambition to increase the number of houses that we produce every year, it's not going to happen overnight. This is quite a long-term project. So I think it's something the market is very alert to, but there is still some uncertainty about how and when this will all fall into place.
Yeah.
Obviously, we've got the whole interest rate dynamic as well. So, I think the sentiment will probably improve here, among other places, when we get the rate reduction that is being penciled in for first week of August. So a few other bellwether stocks along with the house builders that are noted this week. We had a trading update from Wetherspoon. They were talking about a like-for-like sales increase in the period to first week of July was up nearly 6%. But I think that's a slightly slowing trend. But they were saying that their per pub sales were over 20% higher than the pre-pandemic levels. But as ever, when you're dealing with rising costs, you've got the whole profitability thing to deal with. And Tim Martin doesn't mince words when he updates the market. It's always worth reading what he has to say. And one of his big things has been the competitive environment of the pub industry with the supermarket trade, the on-trade versus the off-trade. He said the last government failed to implement tax equality between pubs and supermarkets, leading to pub closures and underinvestment. Wetherspoon hopes that the current Chancellor, with a Bank of England pedigree, will understand how many beans make five and rectify this inequality. Clearly, he continues to think that he's trading at a disadvantage, which I think from a tax perspective he is. But I don't actually think what he's talking about is probably on the top of the priority list of the incoming government. Other bellwether stocks, which I thought were interesting, included Johnson Service Group, which I've been following for a little while. They were saying that the supply of what they called Horeca, which is basically cleaning bed linen for the large hotel groups, is continuing to see improvement in volumes across the estate. And their workwear side, where they're providing customized workwear rental to large employers, they're showing a much slower rate of improvement, but they're seeing a healthy level of customer retention. But we've also had updates from some of the recruiters this week as well, which is always worth a look.
Yeah, they're interesting, actually. So we had Hayes and Page Group both came out with guidance, which was sort of the low end of expectations or effectively modest warnings in both cases. And I think they're both seeing global markets for recruiting, whether it's temporary or permanent recruiting, are still tough. The landscape is still difficult. So although there are lots of positive signs, the markets as they are do remain tricky. And both shares fell relatively sharply on the news. But interesting, they've both recovered almost all or even slightly more than the amount they fell earlier in the week in the days since. Okay. So maybe they've been benefiting that dispersal trade that you described or a recovery of sentiment across the board. But either way, they've both been quite cautious, but the market's been relatively kind in the way it's responded. So interesting to see. And obviously, well, hopefully that bodes well for the future. If they can start to hit numbers or exceed them, then there could be bright times ahead. So yeah, lots of quoted news. What about next week?
We're going to get Q2 GDP data from China Monday. So year on year, the rate is expected to fall from 5.3% growth to 5.1%. We're going to have a speech from Jay Powell, so people will be going to be watching that closely for any change of tone since these lower than expected inflation figures from this week. We're also going to get US retail sales data, which will be expected to be unchanged. On Wednesday, we're going to get UK June inflation data. So looking for another print at the 2% level, unchanged month on month. We're also going to get UK unemployment data for May. Again, an unchanged figure expected at 4.4%. Also on Wednesday, we're going to get a rate decision from the ECB. Again, unchanged. That was pretty well guided. We had the cut last month and they were pretty well said that that's probably it till third quarter at least. And we're also going to get Japan's June inflation data next week. Again, unchanged, but at a level of 2.8%. So when you consider that the Japanese 10-year bond is at 0.1%, if Japan's inflation data spikes significantly above expectations, I think that could be a bit of a trigger point. And then finally on Friday, we get a UK's June retail sales data. The expectation is for a 2.9% increase from a negative figure last month. The other thing next week is we're going to have the US Republican Party convention, which is going to be the Donald Trump show, which is going to be painful for a lot of people, particularly given that the concern over President Biden, and that concern is more about if he can complete his next sentence rather than his presidential term, let alone run for another one. So it's going to be front of mind again next week is how long can Biden carry on and who the US electorate are going to be voting for come November.
Okay. And it sounds like lots of economic data to come through as well. So plenty to focus on for next week. And between now and then, we've got the small matter of the football. So fingers crossed for Sunday evening.
Yeah.
Hopefully a good result there.
Let's hope they can bring it home.
Exactly right. So fingers crossed.
Absolutely.
Thanks very much, Jeremy. We'll catch up this time next week.
See you then.
Talk to you then. Thanks.
Brought to you by Progressive Equity.